This week's release of the latest national account figures will be a crucial indicator of the health of Australia's economy, which has so far defied the global economic slump. One man well placed to talk about the world economic outlook is Jim Johnson, the former chairman of the American mortgage giant Fannie Mae, now vice chairman of a Washington-based merchant banking firm and a director of Goldman Sachs and the Target Corporation. Last year, he was handpicked by Barack Obama to find him a vice presidential running mate before being forced to withdraw from that job after accusations he was given favourable rates on a number of home mortgages. Jim Johnson is in Australia as a guest of the US Studies Centre at the Sydney University, and I spoke with him earlier today. Jim Johnson, your corporate and political relationships would suggest that you very much have a finger on the pulse of the American economy. What's your reading of the state of health?
My reading is that we should be substantially more positive than the current consensus seems to be. People are revising their views now. People are upping their growth projections for the third quarter and for the fourth quarter. But I think we do have some positive momentum. I think the American consumer will be coming back. I think the inventory correction is a big consequence of where we are right now, and I think that will change and move forward. So I'm substantially more optimistic than the consensus for the next 6 months.
What makes you optimistic, particularly regarding the American consumer, which makes up something like 3/4 of GDP? And if you look at consumer confidence and if you look at consumer spending, they're pretty slammed at the moment.
Well, the American consumer, I think, is in transition right now. There's been a lot of balance sheet restructuring. There's been a lot of caution about these last several months because they have been very difficult. And there's no question people are apprehensive about unemployment. On the other hand, a lot of restructuring has been accomplished. And I think as we replace inventories now, and as we move forward with the trade opportunities, export opportunities, very low interest rates, a recovery in the housing markets, I think there are plenty of dimensions that are going to produce a more positive recovery in the second half.
In this country, the head of Department of Treasury, Ken Henry, has warned of a possible second shockwave. And indeed, others have pointed out that only something like $1.5 trillion of the $4 trillion of toxic assets estimated by the IMF have actually been accounted for. How big do you rate the risk of a W-shaped recovery, if you like?
I think the W-shaped recovery is highly unlikely. It may have been one of the theoretical possibilities that deserved substantial attention 9 months ago. But I think now, as you look at industrial production in Europe, as you look at the Chinese stimulation, the Australian stimulation, the U.S. Recovery, I think the recession is over in the United States. I think we will have positive growth in the third quarter, and I think we may have substantial positive growth, perhaps 3% or more.
By when?
By the end of the third quarter.
That's a lot more than many people are expecting.
It is, but I think people are now consistently revising their outlook. I think they're consistently revising their outlook upward. And I think that the policies that have been put in place to stabilize the banking system and the other adjustments that have been made have been very positive.
You were chairman and chief executive of the mortgage giant Fannie Mae in the 90s. You left in 1999, and 10 years later, or 9 years later, Fannie Mae was placed under effective government control, an organisation basically too big to fail. How culpable do you think Fannie Mae and its smaller brother Freddie Mac was in the subprime disaster that led to the global crisis?
Fannie Mae was by no means a leader in the subprime movement. Fannie Mae only in 2004-2005 began to purchase what's called Alt-A mortgages, which is between subprime and prime mortgages. I don't think, though, if I could just pause for a moment, I'm not so sure. I mean, I don't happen to think that what we did in the 90s or even in the first 5 years of the 21st century at Fannie Mae had much to do with this crisis. But nevertheless, the crisis is here. Fannie Mae is now in conservatorship of the federal government and is, along with Freddie Mac and the Federal Housing Administration, the source now of a very high percentage, 70–80% of the mortgage finance in the United States, that's allowing people to purchase the foreclosed homes, and it's keeping credit flowing to the home purchase market. So I think, as we say, mistakes were made in all parts of the housing finance system. I think the lesser part of that was Fannie Mae and Freddie Mac. There were a lot of other players that made much bigger mistakes, and the lack of regulatory oversight was a very big problem.
That's an interesting question, though, because you were well known when you were leading Fannie Mae for being a very strong lobbyist, I guess, against regulatory oversight, if you like.
Well, we had plenty of regulatory oversight at Fannie Mae. We were not in products that caused a problem. I think the oversight in terms of regulation is going to evolve very fast in the next 6 months in the United States. There's a lot of global focus as well, as you know, through the discussions at the G20 and the G8, and I think there will be a good deal of additional focus. The one thing that's clear is that there will not be massive amounts of money moving in the global financial system that nobody has the responsibility to track and understand and try to protect against the systemic threat. And that's going to happen in the United States and other countries on an individual basis. I believe it will also happen on a global basis.
Another issue, which I guess also reared its head at Fannie Mae, but is also far broader, is the one of executive pay. And this is something that's going to be discussed at the G20 Finance Ministers meeting in London later this week. You're on the board of a company, United Health Group, which granted its CEO more than $1.4 billion in stock options. Can you describe to me how you sit around a board table and deal with those sorts of numbers?
Well, there are two things. First of all, one, I don't serve on the board of United Health anymore, but that's a detail.
But this was, you were at the time?
Yes, and nobody granted $1.4 billion of stock options. That is a misstatement of the fact. The fact is that he was granted about $200 million of stock options, and the stock went up by 7 times. So if you have stock options that pay off, that's because the company's stock has gone up dramatically. That's what you want to incent an executive to do.
To that extent, though? I mean, you were aware clearly that if it went up that many times, which must have been a possibility if you had confidence in him, 1.4 billion would seem an enormous amount of potential exposure.
It was the most successful large cap company in the United States. So no one ever did imagine that anything would be that successful. It was the single most successful stock on the New York Stock Exchange.
But was it a mistake? Because of course regulators did claw some $600–700 million back.
That had nothing to do with the size. That had to do with the stock option backdating dynamic. I headed the investigation for that, and I went backwards and forwards through all those things. It was not a quantity question. It was a flawed mechanism question having to do with backdating options. So that I think there's probably some level of compensation, no matter how well your company does, that people would agree is too much. I do not believe, though, that what you ought to do in a capitalist system is to tell people that they have ceilings on what they can earn if they're paying their taxes, if they're earning for the shareholders, if they're the most outstanding company in the country. I don't like the idea that you say, okay, you're the best television person, you have the best approach to these things, you're building more and more and more and more audience, but you shouldn't be paid.
So you fundamentally would say that we don't have a problem with excessive remuneration?
I think we do have a problem with excessive remuneration if it is not in any way related to risk, if it's not in any way related to a long-term review. I think there should be clawbacks. I think it should be equity-based. I think people should get it over time. But I don't, as an absolute basis, I like the idea of accountability, pay for performance, and then if the performance isn't there or the accountability isn't there or it's only short-term in terms of taking the risk and then later on giving the government the problem, I believe that people should be responsible for sticking with the risks they take.
Jim Johnson, many thanks for joining us.
Thank you.